You know, Seema, earlier today, our European colleagues, they had a official on from the IEA, IEA out with a report talking about oil supply and demand. And very notable part of it, they said demand's lower just globally, with about half of those downgrades and declines coming from the U.S. and China. What does that say to you about the U.S. market? Is that possibly a signal of what's going on in the U.S. economy and maybe even a foreshadowing of what we could see coming up in earnings season?
I think it's an interesting idea. I mean, generally speaking, we've been hearing from a growing number of analysts really expecting oil prices to stay fairly muted. And as you said, there's been a drop in demand, which maybe is a signal that, across the globe and including in the US, there has been some economic slowdown. But I think it's important to emphasize that any slowdown that's taken place in the US so far is really, really modest. And it's very much counter to some of the concerns that had been in play earlier this year.
All right, so you're saying it's a bit counter to that. I want to talk to you just about the threat to the market and even the global economy. With the continuation of these tariffs, the president saying he's going to send a letter to the EU possibly today, also slapping those tariffs on Canada. As an investor, how should you view that? I think the president did make actually a very valid point that his tariffs seem to be well received. We see the NASDAQ and the S&P hitting new highs.
Yeah, absolutely. With the market doing so well and having just come off of the big, beautiful bill, you could say that President Trump is feeling somewhat empowered to push forward with his tariffs and maybe a slightly more elevated level than the market has been anticipating. But I think the way that the market is reacting at the moment is maybe a little bit reflective of the fact that they do believe a lot of this is negotiations and that the level that tariffs eventually end up at is going to be somewhat lower than where they are today. So look, there is a lot of potential for noise. There's a lot of potential for some turmoil for the markets. But at the moment, quite rightly, the market is really focusing on what is still a fairly constructive backdrop and keeping an eye on what earnings season is going to start telling us from next week.
You know, it's interesting that you're saying it's a constructive backdrop. I want to refer to something we just talked about before, the Brazilian ETF. That's something I think a lot of investors have paid attention to, at least this week with the tariffs on Brazil. We saw pretty deep declines in it. It's down about 5% this week. Is that potentially overblown? And our knee-jerk reactions to other countries facing tariffs, are they overblown in many cases? Brazil in particular, their leaders have said they don't necessarily need the U.S. market to sell into. And, of course, we had the BRICS nations meeting in Brazil earlier this week, kind of strengthening their ties. So whether we're talking about Brazil or other nations getting the tariffs, if they take a dip, is that an opportunity in your mind?
It could be. I mean, look, there is clearly going to be some economic impact on the various countries. We've been doing some deep analysis into how the countries are going to be impacted. And certainly places like Mexico and Canada do stand to be somewhat affected. China's impact for them, for example, is fairly muted. So it is quite nuanced across the countries. But I do think it is quite right that the market needs to start looking through a lot of this tariff noise, knowing that, look, wherever it is today, and even after August 1st, there will still be a lot of volatility. And typically what you also see is that over time, companies do find ways to navigate this. So this is near-term turmoil. It doesn't necessarily mean that companies in the long term are going to be very negatively affected. They will learn to adjust and find ways of navigating this new environment.
Also, you say you like corporate bonds. I'm just curious, why not treasuries? When you look at the long bond, the 30-year, it's trading at pretty much its highest level since all the way back in 2007. I'm looking at the 2-year. It's pretty elevated historically as well. Why are you looking right now at corporates as opposed to treasuries?
Well, I think the key thing, again, is that constructive macro backdrop. You can just get a bit more of a pickup when you're focusing on corporate credit. The fundamentals are still fairly strong. You've seen strong balance sheets from a number of these companies. And even we're starting to look more and more at high yield and emerging market debt as well. So you get that additional pickup. And the key thing is, as long as there is no recession in the outlook, then defaults, et cetera, are going to stay fairly low. It is quite nuanced. You do need to look at each company very specifically, look at what each one, how they're going to be handling the forthcoming situation. But I do believe that in this kind of backdrop, you can be thinking about going a little bit more risk on rather than just focusing on treasuries.